In Chapter 12, we're going to go over some lessons from capital market history. In this chapter, we will learn how to compute basic returns for historical investment, also risk measures calculations. After finishing this lecture, you shall be able to rank performance of different investment categories based on historical performance data. We will also visit efficient market hypothesis theories in the end. Are you interested in investing in stock market? Do you know what kind of return you might receive? Let's take a look at stock performance in year 2013. S&P 500 and Nasdaq index are up more than 30%. There are winners like Fannie Mae, Freddie Mac, with returned around 1,000%. There are also stocks fell more than 50%. Clearly, there is risk in stock market investment. In this chapter, we will study almost 9 decades of market history to find out performance of different securities. How to evaluate security performance? 2 important measures are commonly used to describe a security performance. One is return, the other is risk. Take a look at the average returns and the standard deviation for the 7 different securities from 1926 to 2013. So we're going to learn how to calculate average return and standard deviation later on. Return can be measured in total dollar amount or percentage returns. The total dollar return was decomposed into income from investment and the capital gain or loss due to the change in price. When you buy a stock or bond, you may receive the cash dividend or coupon payment. The price of the stock also might go down, up or down, when you're about to sell it later. The percentage return is simply the total dollar return divided by initial investment. Let's take a look at one example. You bought a stock for $35, received a dividend of $1.25. The stock is now selling for $40. So what is your dollar return? As the cash dividend is $1.25, stock price changed from 35 to 40, so the total dollar returns is $6.25. The percentage return is the $6.25 divided by the initial purchase price, which is $35. And dividend yield and capital gain yield is $1.25 over 35 or $5 over 35. Please study these following examples. In the case of the bond investment, how much is your investment income? How much is your capital gain? How much is the total dollar return and percent return? Pause a moment, take out your paper and calculator. See if you can get the answers right. Let's take a look at the reported average return for 7 securities over 1926 to 2013. Could you rank them according to the highest return to the worst return? Let's do it together. The highest is small company stock, followed by large company stock, then long-term corporate bond, long-term government bond, intermediate government bond, treasury bill, inflation. So how much more are you getting compared to a safe benchmark like a T-bill? Have you heard about the risk premium measure? It is also called excess return measure. It is a return reward for the amount of risk in the investment. To compute risk premium, simply subtract risk-free from the original return. In practice, T-bills are usually used as a benchmark as risk-free assets. Question: is risk premium a return measure or a risk measure? Pause a moment. What's your answer? The correct answer: risk premium is a return compensation, a return measure. Let's now take a look at how to calculate the risk premium for the securities we mentioned earlier. For example, the average return for large company stock is 12.1. Using T-bill as a risk-free assets, which is 3.5, we get risk premium for the large company stock is 8.6. Right? We can do this for the other security as well. Remember, so this risk premium can be used to any risky investment, stock, bond, mutual fund, or real investment. Now let's go back to security for performance evaluations. Remember we mentioned that there are two measures. One is return or average return. The other one is the measure of risk. The measure of risk is called standard deviation. We go to the calculation in a minute. Let's now take a look at the standard deviation reported. Can you rank them from the highest standard deviation to the lowest? So let's do this together. So the highest standard deviation is the small company stock, then the large company stock, followed by long-term government bond, long-term corporate bond, then intermediate government bond, inflation, treasury bills. You probably also notice the higher standard deviation, the wider the frequency distribution on chart. Also, typically, the higher the standard deviation, the higher the average returns, except two pairs in among these 7 securities. One are these two, long-term corporate bond versus long-term government bond. The orders is reversed. Then is treasury bill and inflation. How to calculate the variance and the standard deviations? First of all, I will call this as a historical variance measure. The reason is the data we used is historical return. For example, annual returns in the past 5 years. The calculation involves 3 steps. Step 1, find out the average returns. Step 2, calculate the deviations of each annual return from the average. Then take the square, then add up, divide by the number of years, minus 1. Last step is just take square root. Right? So the ultimate goal is find out standard deviation. Let's take a look at one example. Step 1, we want to find out average returns. So add up 4 of the annual returns, divide by number 4, we get average return 10.5. Then, for each of the annual returns, find out the squared deviations. For example, the first year, annual returns 15%. So we subtract from 10.5, take a square. We do this for the rest of the annual returns. Then add up, divide by 3. So this is our variance term. Lastly, take square root. Right? So if you are using the financial calculator, please keep at least 6 decimal places. Here's a table showing how we calculate standard deviation in the previous example. Now, after we calculate both average return and standard deviation, how can we understand the performance a little better? For example, for large company stock, we found average or mean is 12.3%. Standard deviation 12%. Suppose it follows a bell-shaped distribution. Remember how to find out the 68%, 95%, or 99% probability windows, right? Okay. So question is, does large company stock follow a bell-shaped distribution? Take a look. So this is the frequency distribution of return on large company stock from 1926 to 2007. As you see, the frequency shape follow very close to a bell-shaped curve. So it seems this is a reasonable assumption. Let's refresh our memory on how to find out the boundaries for 95% windows. Okay, so we have the mean and the standard deviation. So take a look at the normal distribution chart. So in the middle is mean. So the 95% window is a 2 standard deviation away from the mean. So we will simply use the mean 12.3% plus or minus 2 times standard deviation 20% to find out the lower bound and upper bound of the 95% probability windows. So if you are investing and holding the large company stock, so next year we can predict more than 95% chance your return is above negative 27.7% and below 52.3%. Does it make sense? I'm going to talk about there's two ways to calculate the average. One is arithmetic average, the other is geometric average. The arithmetic average is simply the simple average return we used in the previous lines. The geometric average, considering the compounding effect. So the following are the formulas. So first let's look at the overall. Which one's better? Unfortunately, both are a bit biased. Arithmetic is too optimistic for long term, so it tend to be too high. And the geometric average is too pessimistic for short term, so it's way too low. So which return shall we use in the practice? Generally, for short-term investment less than 20 years, we recommend the arithmetic average. For the longer term, 40 years above, we use geometric average to consider the compounding effect. For the investment horizon in between 20 and 40 years, we tend to use a mixture of both. Let's take a look at this example and find out the two calculations. So the arithmetic average is simply add up 3 annual returns, divide by 3, and the geometric average, we need to first multiply 1 plus annual return and get the result, then raise the whole thing to power 1 over 3, subtract 1. Can you verify if the arithmetic average is higher than the geometric average?